Mike, I want to get your views on risk assets and not so much equity at this point, but what's been happening in credit. Short-dated IG has been really soft. A lot of people very focused on short-term borrowing costs, whether it's in treasuries, Libor, for instance, another issue. How does that bleed out from here? You've talked about the vol story bleeding out from equities from the United States outside to other regions, to other asset classes. How does that softness in credit start to bleed out into risk assets?
It's really interesting, Jonathan, and it's one more case in which developments in Washington impact the markets, in this case pretty quickly. There's been effectively a buyer's strike by these big companies who have piles and piles of cash overseas, mostly big techs, a few others. Historically, they've been really active in typically 1 to 3 year securities. This year, not buying much. So you've got this massive uptick in terms of supply on the front end relative to what the demand capacity is out there. So it's really been very disruptive, and I think that's impacted Libor as well. Now, Libor sounds like this arcane thing, but guess what? Most loans in the U.S. outside of residential are tied to Libor, so it really does impact the real economy too. So all sorts of permutations here to consider.
How do you see this developing, Peter?
Yeah, I think it slowly becomes an issue. Even commercial paper, which companies rely on heavily for financing, it's increasing, so that'll hit the bottom line a bit. But I'm also really worried about what does that do to the consumer. You know, we've seen auto sales slow the last couple months. Is that a function of higher costs of financing these products? So for big ticket items, that cost of financing is going. I think there could be a bigger drag on the economy than we realize. Again, I'm not quite sure why we're in such a rush to hike when we're not even seeing the impacts of the prior hike.